Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so good to see everyone, all of the investors from around the world. In today's meeting, we have a very exciting topic that we're going to talk about: mortgage note investing, purchasing debt that is secured by real estate assets. So it's a great topic. It's a great way to make money, and we'll go ahead and get started. So let's take first an example of what is a note purchase. Let's imagine a situation where there is a property that is sold for a price of $120,000, and the buyer, instead of going to the bank, the buyer goes to the seller, the owner of the property, and says, "Listen, I have $20,000 that I can pay you today, and I will sign a promissory note for $100,000 that I will pay you over time, and I'll secure that promissory note with a mortgage." So that is basically the situation. So let's imagine that there's $100,000 debt. A seller agreed to this. We'll talk about why a seller would agree to this later, but there are situations, particularly in the United States, that are fairly common where it's not that hard to find a seller that will carry a mortgage. So the seller accepts $20,000. They have some paperwork put together that the buyer's going to make payments every month of $877.57. And let's imagine that they agree on an interest rate of 10%, because the seller explains to the buyer, "Look, I'm not a bank. I'm not going to finance you at a bank rate. I need a higher rate of interest." And they agree on 10%. Now let's imagine that this arrangement has taken place where essentially what happened is the seller said, "Why don't you go to a bank?" And the buyer said, "I can't get a mortgage from a bank. A bank won't give me credit, but I've got 20,000. I can pay you 20,000 today." So that's how that situation might arise. So let's imagine that 60 months have passed. Every month, the buyer has paid $877.57. And there are still, on a 360-month, a 30-year mortgage, there's 5 years that have of payments that have been received. So the current balance on the debt is approximately $96,574.32. And let's imagine that the seller wakes up one day and needs or wants cash. So the seller, the first thing he does is he calls his buyer and says, "Hey, it's been 5 years. Can you please get a mortgage at the bank? Because I need to be paid off." And the buyer says, "I can't get a mortgage at the bank. They still won't give me a loan because I have bad credit and I'm self-employed." So at any rate, then the next thing the seller does is he jumps on the internet and he types in something like "sell a mortgage note for cash" or "convert a mortgage note to cash." And he finds a lot of companies that are in the business of purchasing mortgage debt. He'll contact one of those companies. He might contact, for example, one of my companies, Alamo Mortgage Holdings. We do actually purchase mortgage notes. And he would say, "Hey, I'm owed $96,574.32. Please pay me that amount and you can have this mortgage note, and then you can earn a 10% rate of interest." Well, Alamo Mortgage Holdings would say, "That's not really something we're interested in. We need a higher yield." And let's imagine that there was some negotiation that took place where the agreed upon yield was 12%. And we'll talk about yield a little bit later. That would mean that the maximum that Alamo Mortgage Holdings or another buyer could pay if they wanted a 12% yield would be $83,322.39. Yield's a bit different than interest rate. The interest rate hasn't changed, but because the note is being purchased at a discount, the yield has increased. So let's talk about the distinction here between being a landlord and being a lien lord. Most people have heard of being a landlord. They're familiar with all of that, but they're not familiar sometimes with being a lien lord. So basically, you're the bank. That's the best way to describe it, is you are the bank. So what is a mortgage? Mortgage is just a simple agreement that it derives from the French language, mort and gage. It means dead pledge. And that's because years ago, when people would take out mortgages, they would sign them and they would not live until the end of the mortgage. And that's why it was translated as dead pledge. So that's kind of the history of it. As you may be familiar, the first payments are primarily going to pay interest, and there's less that's going to pay principal in the beginning. But as the years pass, the amortization schedule changes on an amortizing mortgage. So in this example, this is a 30-year note, and you can see how the principal balance at first goes down very slowly, but then it speeds up towards the end where it is amortizing faster. So what exactly are some advantages of mortgage investing? First of all, if you compare mortgage investing with being a real estate investor, it is far easier to be a mortgage note investor. You don't have to repair properties. You don't have to do any of that. You're just basically signing some agreements on paper, doing deals that way, and you never have to do a rehab. So if you don't like doing rehabs and you don't want to supervise a property, being a mortgage note investor offers that benefit. Another advantage is that a lot of people, if they're just real estate investors, they don't have a lot of diversification in their portfolio, but by also investing in mortgage notes, they can obtain more diversification. And then the other thing is, if mortgage note investing is done correctly, it can be less risky than actually handling physical real estate, because anything that breaks on the real estate is the responsibility of the landlord, not the lien lord. So a lot of advantages to mortgage note investing. Okay, what determines the value of a mortgage note? There's 6 factors that are going to price a mortgage note. The first factor is the buyer. So if you have 2 different buyers, and one buyer is a government employee that gets a government paycheck reliably every time, they're paid on time, maybe they work at the postal service, that buyer is in one category. Then you've got another buyer that maybe is a young person that is going to start a new Facebook competitor. They're only 21 or 22 years old, and they've got a dream to start a tech company, but they don't have regular income. The buyer that is the safer bet for you as the bank is the postal worker, because that government employee is getting paid no matter what happens. Whereas that tech company, that guy might go on and make a bunch of money, or he might fail, and you're not getting paid if he fails. So for that reason, the buyer is important in determining the value of a note. The collateral. Here's a great example. Let's say that we go back to that example of a property that sold for $120,000 that's worth, say, $120,000. That's fine. You know, that's a normal situation. But what about if you had a situation where a property was only worth $120,000, and yet the owner managed to find somebody that would pay $200,000 for the asset? So imagine a situation, maybe this is in the state of Texas, where there's an out-of-town California buyer coming in, and the California buyer doesn't know the prices. He doesn't have a real estate agent. He meets somebody somewhere, maybe at a bar, and they have a conversation, and the California buyer says, I'm looking to buy some real estate, and the Texas seller says, hey, I've got the perfect thing for you. I'll sell it to you for $200,000. California buyer doesn't know the prices. They think, hey, that's a good deal. That's a lot cheaper than $1 million in California. It's only $200,000. So they agree, they do a deal. But the fact that somebody signed a note for $200,000 doesn't make that note worth $200,000 if the collateral is only worth, for example, $100,000. So the collateral is very important in pricing the note. The other thing that's important is the down payment. If you have 2 buyers and one put down a large down payment, maybe they put 10, 20, 30% down, versus another note where there was a 1% down payment. The note with a 1% down payment has a far higher probability of a default. So you have to take that into account. The interest rate's important. So if you have one note that pays 5% and you have another note that pays 10%, you want to buy the 10% note if all factors are equal. The history. How have the payments been made to date? Is this a new note where you don't know if the buyer is going to pay or not? Or is it a note that is a 30-year note that the buyer already for 5 years has been making payments? The history of the note has a lot of value on the likelihood of receiving the payments. Also, are the payments being managed by a servicing company? And by the way, if any of you in the United States need a servicing company, I highly recommend SecureNet Loan Services in San Antonio, Texas. They are a great company and they do a great job with servicing mortgage notes. So the last thing that's important is the paperwork. Because if you buy a note and the paperwork's not done correctly, you may not even have a valid claim to be able to foreclose if you don't receive the payments. So was it done properly? Were it closed at a title company with lawyers doing the paperwork, or was it just two guys that they are sitting at a kitchen table, they agree to a deal and they take out a pen and paper, or they get on LegalZoom and they draft up their own legal documents? So all of these things are important. So what about if the note you're buying is not making payments? Let's imagine a situation where you are going to buy a mortgage note, and let's say that this particular mortgage note is 1 million or more. In that case, you're going to want to make offers at between 30 and 70 cents on the dollar. So on $1 million mortgage debt, you might offer 500,000. But if the note is a lower value, say the note is below 100,000, imagine the note is 100,000. In that case, you might only want to offer 10,000 to 25,000. There's a lot of factors in this, but bank foreclosures are terribly expensive when they're done by the bank. The average bank foreclosure in the United States costs 25,000. So banks are willing to accept discounts on non-performing notes. So how do you explain the discount to the seller? If you have a seller that calls up and says, hey, I've got a mortgage note, I'd like to sell it. You want to go through and explain how the time value of money has to be factored in. It's also a good idea to, you could use an example of a grocery store. You could point out with the seller, hey, if you buy groceries today, you can buy this amount, but if you went back 10 years, you could buy a lot more for the same amount. So when I buy this note, it's going to have a lot less buying power. Another thing that's important is you want to point out problems with the transaction. You want to find as many problems as you can so that in the seller's mind, he sees, maybe my note was done wrong. Maybe it's less valuable. Okay, what about purchasing packages of notes? Here's an example of a package of mortgage notes. This is a real package. And you can see here a lot of different notes. If we look through this, you can see that these notes have different balances. This one has a balance of 41,400. It's at about a 12.5% rate. And you see over here current, that means they're current on the payment. Here's one that has a face value of 21,450 and an unpaid balance of 13,489. So these sorts of things can vary. This is a 14.75% rate. This is a 10.5% rate. But these sorts of packages of notes, they do exist. And they're the type of thing that Alamo Mortgage Holdings, my company, focuses on acquiring. We purchase packages of mortgage notes in the United States in the state of Texas. So mortgage note investing is very powerful as a strategy. It has a lot of benefits, but I wanted to just show an example. So a new investor, instead of trying to buy all of these notes, they might buy one or two. They may just when they're getting started. But if you're doing this as a corporate level where you're trying to do a larger acquisition, you could be looking at packages where you're able to purchase a package of mortgage notes. And it's the same whether you're purchasing an individual note or a package, but the advantage to purchasing a package is if you've got one bad note in a package, it's not that big a deal. But if you bought one bad note and you've got no income coming in, that's a big deal, and that's no fun. So that's what a package of mortgage notes looks like. Okay. Why Alamo Mortgage Holdings? Why is it better to invest with a company like Alamo Mortgage Holdings compared to doing note investing alone? Sometimes I get asked this question. Well, the advantage is if you work with a company like Alamo Mortgage Holdings, you've got a team that's working for you. Yeah, you may not make as much money as if you buy individual mortgage notes, because Alamo has to make a profit, but you're not going to make the sort of mistakes that may happen if you're new to purchasing mortgage notes. So it's a big advantage working with a company because we pay around 8% at Alamo. And a lot of people, they try the mortgage note business and they think they can get higher than 8%. And they try it and they make mistakes. Maybe they buy a second lien note and they pay too much money thinking they're getting a good deal. There's a lot of mistakes that someone can make in the mortgage note business. So if you don't have proper education and training in buying mortgage notes, a lot of times it's just easier and better to work with a company like Alamo Mortgage Holdings and stick with your core business if you're maybe a doctor or a dentist, instead of trying to learn the mortgage note business, which takes a lot of training to do it properly. It's simple when you explain it, but when you actually get down to the nuts and the bolts of it, there's a lot of moving pieces that you've got to be able to stay ahead of. So important there. Okay. Here's an interesting graphic. This shows a UK gilt. This is a 30-year gilt. Gilt is a government bond in the United Kingdom. And you can see here how the yield is moving. Alamo Mortgage Holdings, we pay an 8% yield, which is right here. So this is where we are on our notes. Every year we set the rate on our notes, on our bonds, and we pay 8%, but once a year we adjust it. So that's a very good yield compared to the historical average. It's been many years since those yields have been above 8%. So it's definitely a good advantage. Another advantage is if you're in the United Kingdom, a lot of investors in the UK, they're so used to thinking about the UK that they think, well, it's all the same. I mean, I can get an 8% return in British pounds. I know investments over here in the UK where I can get 8%. Why would I want to get an 8% return in the United States? Well, I guess that depends on some factors, but you may want to think about the history of the British pound sterling and the US dollar exchange rate ever since the Bretton Woods Agreement towards the end of World War II, where exchange rates were initially fixed. At that time, the British pound sterling was much, much stronger. One British pound sterling would buy 4 American dollars. So it was a world stronger. But look at what happened. Look how the dollar has been getting stronger and stronger against the British pound, because 1 pound used to buy $4. Then 1 pound would only buy $2. Now 1 pound, as of the 1st of January 2023, will only buy $1.21. So if you've got all of your investments in British pounds, you are exposed to a lot of currency risk there if the pound keeps going down in value, even if you get your 8% rate of return. So it is a wise idea to consider diversification in your currency. And with Alamo Mortgage Holdings, we can help you with that, where if you have a portfolio and you want to diversify your currency, but you need income, if you want passive income, we can help you with that, where you can purchase one of our bonds. You can buy the bond in either dollars or in pounds. We don't make any money on the exchange rate. We convert it at the listed exchange rate. And then from there, you actually can benefit in terms of it protects you from the exchange rate movement. Okay, so another advantage to Alamo Mortgage Holdings is that we can offer you immediate passive income. There is no learning curve. You don't have to go through and learn a lot of complicated things. When you're working with Alamo Mortgage Holdings, you've got an experienced team that's working for you. A lot of experience. Our team members have worked with a lot of companies that are like Microsoft, Chevron, Exxon, and Fora Financial. And we take care of everything for you so that you can enjoy the passive income. So that's a big, big advantage to working with Alamo Mortgage Holdings. Okay. Just a couple of reminders. First, please fill out the sign-in sheet if you have not been here before. And if you've been here before, you don't need to fill it out. Okay, and then you're also welcome if you know any friends or colleagues that might want to learn about investing. They are always welcome. Come one, come all. So that is it for our presentation. I'm going to stop the recording and then I'm going to open it up for any questions.